Welcome to TheStreet.com TV here on Wall Street Confidential. This is Jim Cramer. Welcome. Good. I was reading your very comprehensive article on Real Money right now entitled Growth Stocks Are Back. And what really caught my eye was a line in there that said, forget housing. It's all about what's happening overseas that is helping this economy in the U.S. grow.
Right. I mean, I think the important thing if you're in the media is to try to sell people in a scared fashion. Remember, the media's view is not necessarily coincident with the investor's view. You have to kind of focus on what's scary, what's going on, because that sells. And I respect that. I mean, having been a journalist all my life, I recognize that you don't talk about dog bites, man. Mm-hmm. But it's really important to distinguish that there is a cordon for what's weak. The cordon is, it's Toll Brothers, it's Lennar, it's NV, it's KBH, it's Centex, it's Pulte, it's D.R. Horton. These are where the weaknesses are. Mm-hmm. They're domestic companies, pure domestic companies. Retail is a very weak situation. Again, they're pure domestic. Now you could say, well, doesn't that matter? No. Not with the S&P 500. Many of these companies have seen the writing on the wall and recognize that the U.S. economy is going to be weak and that the Federal Reserve is going to be an inflation-fighting organization, not a growth promoter. And I think it's important to recognize that it's very easy to focus only on the housing area, and then you'll miss a lot of stocks. Last year at this time, I blew out of Ingersoll Rand, one of the dumbest things I've ever done in my career. A lot of people think that I'll blow out of MYX down here, which I think is funny. I'm only mentioning that because I responded. I run a public portfolio, and it's very discouraging, frankly, to run a public portfolio because people are out there in the answers column of Stock Picker every day banging me, and there's just tremendous discontent. And there's always one or two stocks people focus on. It was Alcam, which I sold at the bottom because people just couldn't take the 58 to 40 run. Bausch & Lomb, which I sold at the bottom at 43 because I just listened to the cat calls. And Ingersoll Rand, which I sold at 38. These stocks have all pretty much doubled. And what I would focus on here is that Ingersoll was a play perceived as housing. That's why I sold it. I couldn't take the perception anymore. Again, I'm focused on the mistakes because the mistakes have to do with the fact that I would never have sold these things if I were a private hedge fund. It's just a different mentality when you're running a public fund. The people just hate you for making mistakes. The reason I'm giving you this history is that Caterpillar's now being unfairly lumped in, like Ingersoll. I think Caterpillar's Ingersoll at 38. And I think that people have to recognize that Ingersoll went to 55. Caterpillar, it was downgraded the other day, and it was a guy who missed the whole move. So it's really kind of pathetic. You have to look at the analysts and see what they've done. I would urge people to use the mistakes I've made running a public portfolio and to buck up and recognize that an Ingersoll, that an Alcoa, that a Bausch & Lomb were unbelievable opportunities when I blew them out because of the perception that I had become a loser because of these positions. Public portfolio, only one run in the country. It's got its hazards. One of the hazards is that you're tempted to sell CAT, not buy it. I bought CAT yesterday for ActionAlertsPlus.com.
I want to come back and talk more about CAT because I think it's a hot stock. We're going to wrap up here. This is Wall Street Confidential. I want to thank Jim Cramer. Thanks so much. I'm Farnoosh Torabi. Stay with us.